I looked at it this afternoon and went, oh, that's kind of cool. Oh, they crashed the CME, did they? Oh, okay, that's good. But I'm not excited about it because it is kind of, I'm already calculated that that's what's going to happen. The precious metals are going a long way and all the commodities are going to go, hard commodities, that is, are going to go a long way. Only just begun. So, as far as I'm concerned, it's not early days for silver and it's certainly not early days for gold. They've still got a rather long way to go.
The moment a quiet market snaps awake always tells you more than a dozen theories. That's the lens Clem Chambers uses when he looks at silver. He doesn't obsess over every wiggle or headline because, for him, the real information lives in the breakout itself. When a price sleeps for weeks or months and then suddenly tears out of its range, that's the market announcing a repricing. You don't need to know the cause. You just need to recognize that the character of the move has changed. Once the direction becomes clear, he treats that first breakout as a measuring stick. If silver surges out of its quiet zone, he expects it to travel roughly the same distance again. Traders call it symmetry. Chambers turns it into a simple roadmap. Wait for the explosion, confirm the direction, then ride the next leg. That's why he isn't fazed by the current noise. Silver drifting sideways doesn't bother him. He isn't watching every tick because drifting markets don't matter. What matters is the moment they stop drifting. When silver finally rips higher, and he's convinced that moment is ahead, not behind, that's when he'll lean in. He even jokes that the trigger could be something absurd, like penguins deciding they want to buy silver. The trigger doesn't matter. The breakout does. He also knows the real stress comes later. At levels like 80, when everyone is suddenly excited and the chart has gone vertical, that's when he'll start sweating over whether the move is finished or just catching its breath. Until then, he's calm, patient, and holding the position, waiting for the market to show its hand. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
If you're at 1,000 and you go to 2,000, the chances of going to 4,000 is 50-50. And when you get to 4,000, the chances to go to 8,000 are 50-50. Well, we're at that 4,000 in gold, and the chances of going to 8,000 is 50-50. So what you're looking for is suddenly, because, okay, I've got this asset, silver, and everybody goes, yeah, who cares? And suddenly something happens, and it goes, bang, and it stops. Now, that's called a repricing. It's repriced. There was a reason for repricing. I don't know, and penguins suddenly decided they needed to buy lots of silver, and it repriced. Bang, and it stopped. Okay, now it's got equilibrium, and so it goes bang, and it goes zzz. Now, the chances are 50-50 that it's going to go as far again, and you could say 50-50 that it'll go back down. And you think, well, that's no help to me. If it's 50-50 up or 50-50 down, I'll pick this direction, and half the time I'd be wrong, half the time I'd be right. But that isn't actually the trick. The trick is when it breaks away from its equilibrium, the penguins want more silver, it goes out of that equilibrium, and then the chances are very high that it's going to go as far again. So basically, you get a signal of a big move. So equilibrium, bang, it breaks out. That's the signal is going to have a big move. And because of the 50-50 rule, it's either going to go a long way that way or a long way that way. So when it does it, you can jump on it. So for me, as somebody with a position of silver rather exciting, I'll sit there and I'll expect it to break on up and then double. If it will break on down, I would go, oh, hold on a minute, I wasn't expecting that. What happened? What did the penguins not want their silver anymore? And I'll reevaluate. And if I'm certain I'm right, I'll be holding on, and then maybe I'll prove to be right. And if I suddenly realize that maybe it's done its thing, I'd get out and keep most of my profit. So the equilibrium breakout one way or the other is a signal of a big move. And that big move is something that you can make the most out of, particularly if you're watching that asset and you know in your mind which way it's going to go. It will give you a signal whether you're right in your assumption or wrong. And that will give you room to either take your profit or sit there and get the next big one. Is that too obscure? I hope not. It feels it. And somebody asked me today, one of my subscribers on Substack, they said, so what do you think about silver? What if it's doing that? And I said, I don't care. I don't care. I'm asleep. I'm a sloth hanging upside down from a tree because I'm so sure of silver going up fairly large way from here that I'm not really sitting on the pixel and watching it go up and down. I mean, literally, I looked at it this afternoon and went, oh, that's kind of cool. Oh, they crashed the CME, did they? Okay, that's good. But I'm not excited about it because it is kind of, I'm already calculated that that's what's going to happen. So I can sit there. When it gets to 80, you'll be seeing the perspiration coming off my brow because I'll be going, oh, is that it? Is that it? Should I take my profit? Oh, but now it's broken out. It's just the fun time to watch in my book, because if you've got a plan, if you worked it all out before, and if it doesn't behave as you see fit, you sell it and you walk away. You wait for the next bus. And when it does break out, you go, yeah, I thought that's right. Yeah, it'll go up and it'll go up quite a long way. Yeah, it'll be fine. But when it does get up there, because obviously I'll be, and everyone else will be thinking, it's going to go to 100. Oh yeah, it's going to go to 100. Should I hang on? And I'll be going, don't want to hang out for $20. And that will be the moment when I'll be, doing that, but not now. And I wouldn't care if it came back to 50 because, the precious metals are going a long way. And all the commodities are going to go, hard commodities, that is, are going to go a long way. It's only just begun. So, as far as I'm concerned, it's not early days for silver, and it's certainly not early days for gold, but they've still got a rather long way to go.
Clem Chambers sees the U.S. financial system as a giant machine with a couple of simple levers, and everything else is just noise. When the government or the Fed pushes liquidity into the pipes, asset prices climb. When they yank liquidity out, prices sag. No mystery. No grand conspiracy. Just the flow of money. That's why the recent slump didn't surprise him. The Treasury held back cash, parts of the government were effectively frozen, and the Fed kept shrinking its balance sheet. With money tight, people didn't sell because they changed their minds about assets. They sold because they needed cash. In an actual liquidity squeeze, everything becomes a funding source. Stocks, gold, collectibles, whatever you can unload. Prices drift lower not because fundamentals collapse, but because buyers disappear. Then the valve opened again. Once the government pushed money back into circulation, he mentioned seeing a number around 110 billion in a quick burst. The pressure flipped. Markets bounced almost immediately, which is exactly how a liquidity-driven system behaves. That's why he's expecting a strong push into Christmas. Looking ahead, he thinks the playbook is straightforward. Gold and silver already flashed the early signals. Copper is setting up next. Oil tends to trail behind but eventually joins the cycle. In his view, you follow the liquidity, not the headlines. Let's get back to the interview.
The US government pumps money into the economy to make sure there's enough money, and it kind of guides itself by the value of the S&P. But when you pump money in, when you print money, if you print it in a certain way, like they've been doing now for quite a long time, it goes straight into assets, and it goes straight into financial assets. And, the government, US government was on pause. So the money flow was on pause, and the cash was being, basically dammed up in the Treasury, and the Fed was going into reverse with QT. So there's a kind of a big clunky machine changing the way it's managing the money supply, and they all crossed over, and there was a big liquidity squeeze. As I was saying on a lot of podcasts, liquidity squeeze is just a pinch in the money supply. And when there's not enough money to go around and the money's not flowing, assets go down. It's like, I better sell my Microsoft. I've got to, pay the balloon payment on my car or whatever. I can't make the mortgage payment. I'm going to sell my gold Rolex down the pawn shop. It's the same thing with all assets. And so when the money stops flowing, down go assets. And when the money starts flowing again, up go assets. So you had this pinch point in liquidity, money supply, and assets go, Well, actually, the investors do that. And the prices go wobble, wobble, wobble. When everyone starts to go, I'm panicking now. Oh, my gosh, it's the end. I knew it was coming. And then they pull the lever with the money supply and up it goes again. And I think I saw something in passing, and this number's going to be wrong, and you can find it out yourself, that they pumped in $110 billion in the last few days, or last 10 days or so. And, that will lift your assets. So, a money supply, a liquidity crunch, down goes the assets. They pull the lever, up they go. And that you're seeing the other side of that. And I think you'll see a really strong run on assets up to Christmas now, which will be ho, 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 very good. So invest in opportunities and look for those opportunities and don't listen to the doomsters. And, gold's been an opportunity, silver's been an opportunity, copper's going to be a massive opportunity, oil's going to be a big opportunity going forward at some point. And you stake them out and you go, well, when this happens, I'm going to buy that thing. And then this happens and then you buy that thing. You don't have to be in there now. You don't have to be scared. You just have to be methodical. And, you've got to be, as I say in my favorite sport, cricket, on the front foot. Or as I was saying in Silicon Valley, you got to lean in rather than lean back. And, that is the trick. And we've seen that with this recent liquidity squeeze and with the government shutdown, that a lot of people have been terrified by it, and then it goes away again. Now, that's not to say if you're in a bubble and you think you're in a bubble, you have to sit there and hope it carries on going. You just have to be leaning in. And if you look at that chart, you can get a sense of proportion. That little bobble is, oh, what's going on? Nobody knows. Fred did this, Jim did that. This strange reason that nobody agrees with. You just sit pat. If your president comes out and says we're going to invade Greenland, then maybe you do want to get out of the market. But, it has to be something pretty cataclysmic to turn around this long-term trend we've been on now for almost ever. I mean, the credit crunch was that thing. The whole of US housing nearly went down the pan. Yeah, well, that's a reason to get out of the market. And yes, at the beginning of the year, what Trump was saying about tariffs was a reason to get out of the market. And, if he had kept to what he said he had done or was going to do at the beginning there would have been a big crash. But if you take the gaps between moments where you really have to think carefully about whether you want to be in, you go Trump, COVID, credit crunch. Well, there's years between those things. And yes, the NASDAQ will go into a bubble. And yes, it will probably crash. But you don't want to get out of a bubble at the beginning of the bubble. You want to get out of it near the end. And that's maybe 2 years away now. So, it's good to be leaning into this stuff rather than sat there going, oh, I'm going to sit on my hands. I'm scared now. It's good not to be scared. It's good to be careful.
Something interesting happens once you listen to people like Chambers long enough. You start to realize that patience isn't passive at all. It's a skill. He treats quiet markets like loaded springs, not dull stretches to be ignored. And once that spring snaps, his whole approach shifts from calm observation to calculated momentum riding. Whether the catalyst is logical or ridiculous doesn't change the core idea. The market speaks through its movement, not its excuses. So the real edge comes from trusting the structure of the move rather than getting tangled in the noise around it. One thought to chew on. If silver does ignite with the kind of force he anticipates, how ready are most traders to stay disciplined through the surge instead of panicking at the first sign of altitude? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.